1 minute ago, the 2026 banking collapse just became inevitable. In early 2026, the screens didn't flash red because of fear. They flashed red because the ledger finally confessed. Most people will say the system broke from panic or bad headlines. It didn't. It broke from a balance sheet that could no longer pretend it was alive. You were told the banks were stabilized. You were told the storm already passed. But stabilization is not recovery. Stabilization is a patient on life support, breathing borrowed oxygen, while the bill collector waits outside. Here is the inversion you need to understand. The collapse didn't begin when depositors ran. It began when the math ran. A bank can survive rumors. It cannot survive insolvency. And insolvency is not a mood. It's a number. Think of a bank as a fortress made of paper promises. Loans are the bricks. Deposits are the mortar. And confidence is the thin paint that makes the walls look like stone. In 2026, the paint peeled off. The paper showed. The public thinks the banking system fails when people lose trust. That's the bedtime story. The real cause is the ledger turning hostile. The balance sheet becomes a crime scene. Assets shrink. Liabilities stay tall. And the difference is called bankruptcy. Now picture the exact moment this became inevitable. It was not a riot. It was not a siren. It was a meeting, a signature, and a quiet internal email that used the coldest word in finance: impaired. That word is a bullet. It means an asset is not worth what the bank claimed. It means the bank's books were a costume. And once one major asset gets stamped as impaired, the rest of the wardrobe starts to tear. We like to imagine collapses as explosions. In reality, collapse is suffocation. Slow at first, then sudden. The oxygen is liquidity, the throat is credit, and the hands squeezing are interest rates. At the peak of the illusion, America's banking system looked like a city of glass towers. Apps that moved money in seconds. Ranches that smelled like carpet and certainty. Advertising that promised safety with smiling families and soft piano notes. Regional banks strutted like they were pillars of the republic. They sponsored local sports teams. They financed diners, dental offices, and small factories. Their logos were painted on Main Street like a flag. Mega banks wore the crown. They had lobbies like cathedrals and balance sheets like continents. Their executives spoke in calm, rehearsed sentences. They didn't sell banking. They sold permanence. And the Federal Reserve stood above it all like a weather god. One press conference could change the price of money. One sentence could lift markets like a puppet string. It felt like majesty. It felt like control. But beneath the surface, the foundation was rotting. The rot wasn't dramatic. It was clerical. It was spreadsheets that assumed tomorrow would look like yesterday. It was debt priced for a world that no longer existed. The addiction started years earlier, when money was cheap and time felt endless. Banks loaded up on long-term assets that paid tiny yields, 10-year paper, 30-year loans, commercial real estate notes that assumed offices would always be full. They did it because cheap money is a drug. It makes bad deals feel safe. It makes risk feel like strategy. And it teaches the system one deadly habit: always refinance, never repay. Then the era changed. Rates climbed. The cost of money rose like a tide. And the banks, loaded with low-yield assets, began to drown in slow motion. They held paper that paid 2%, while deposits demanded 5%. That gap is not an inconvenience, it's an open wound. The bank blank bleeds every day it stays open. And when enough banks bleed, the system becomes a hospital with no doctors. Debt became a living monster in the walls. Not a metaphorical monster, a mechanical one. It moved through maturities and repricing dates like teeth clicking in the dark. Every quarter another batch of loans came up for renewal. The antagonist wasn't a foreign army. It was the bond market. It was the yield curve. It was the silent crowd of creditors who decide what your promises are worth. They don't chant. They don't vote. They price you. By 2026, refinancing was no longer a bridge. It was a trapdoor. Trillions in obligations across real estate and corporate credit faced a new world of higher rates. A loan that once rolled over smoothly now demanded blood. Let that number sink in. $2 trillion of debt needing new terms is not a headline. It's gravity. It pulls down everything connected to it. Banks are connected by design. They share the same air. Commercial real estate was the soft underbelly. Office buildings with empty floors. Shopping centers with shrinking foot traffic. Projects financed under the assumption that occupancy would stay fat and predictable. When values fall, collateral collapses. And when collateral collapses, the bank's asset becomes a liability wearing a disguise. That is when the ledger stops being a record. It becomes a verdict. In 2026, delinquencies didn't need to skyrocket to kill the system. They only needed to rise enough to force recognition. The true killer is not default. The killer is marking losses at reality. Banks survive on a powerful trick. They pretend time will heal. They extend. They restructure. They modify. They call it patience, but it's often concealment. It's accounting anesthesia. Regulators can tolerate denial for a while. Markets can tolerate it too. But once regulators force assets to be marked closer to market price, the anesthesia wears off. Pain hits fast. Capital evaporates. This is where the spiral begins, chronologically, like a noir detective tracing footprints in the rain. First came the deposit competition. Banks had to pay more interest to keep money from leaving. That crushed margins. Second came the bond market's cold shoulder. Investors demanded higher yields to lend to smaller banks. Some refused entirely. That meant banks lost cheap access to funding. The oxygen thinned. Third came the maturity wall. Loans written in the zero-rate world came due in the high-rate world. Borrowers couldn't refinance. Banks couldn't ignore it, and the ledger began to scream. The rule of three is brutal in finance. The cash was leaving. The loans were souring. The funding was drying up. None alone is fatal. Together they are insolvency. At the same time, the digital bank run rewrote the physics of panic. In the old days, fear needed bodies, lines at branches, shouting, news crews. Now fear needs a phone and a rumor. A viral post can move billions before breakfast. A group chat can turn a stable bank into a dead bank within an hour. In 2026, confidence travels at the speed of light, and so does withdrawal. And here's the cruel part. Digital runs don't just drain cash. They trigger algorithms, liquidity coverage ratios, emergency funding thresholds, automatic hedges. The system starts pulling levers on itself. The bank becomes a machine eating its own wiring. It sells assets to raise cash, selling locks and losses. Losses reduce capital. Lower capital scares depositors. Depositors withdraw more. The spiral tightens. By the time a regulator walks into a branch, the money is already gone. The furniture remains. The signage remains. The illusion remains. But the balance sheet is hollow, like a body after the soul leaves. So what was the smoking gun moment in early 2026? It wasn't a dramatic speech. It was a document and a decision, a quiet classification. A bank moved from watch to action. This is the bureaucratic version of foreclosure. The system doesn't announce it like war. It announces it like paperwork. A consent order, a supervisory letter, a forced merger term sheet. In that moment, the negotiation is brutal, even when spoken politely. The unspoken dialogue is always the same. Your assets are overstated, your liquidity is gone, your equity is forfeit. It's liquidation language wearing a suit. We will protect depositors, but shareholders will be wiped. We will transfer assets to a healthier institution. We will close you quietly on a Friday. That Friday detail matters because it's strategic. Weekends are used like tourniquets. Close the doors after business hours. Rewrite the signs. Reopen Monday with a new owner and a calm press release. The public calls it a rescue. The ledger calls it a sale. The bank is not saved. It is auctioned. The carcass is divided. The losses are buried in legal language. Now the climax. The default moment. The point where the bank cannot meet the next demand for cash. It is not always announced as default. Sometimes it's a temporary suspension. Sometimes it's a liquidity event. But the meaning is the same. The institution cannot honor its promises on time and in full. That is insolvency in practice. And once it happens visibly, it spreads like smoke through dry timber. The social consequences are not abstract. Small businesses miss payroll. Families can't close on homes. Contractors can't renew credit lines. The community feels it like hunger, not theory. Credit is the blood supply of a town. When the local bank seizes, the town goes anemic. Shops cut hours, projects pause. Layoffs begin. Not because people forgot how to work, but because cash stopped moving. And that is how banking collapses become depressions. Not through stock tickers, but through silence. A foreman telling workers to go home. A restaurant owner looking at an empty dining room and an unpaid invoice. In this phase, you learn the oldest truth of power. Sovereignty is solvency. A nation that cannot fund itself is not free. A citizen who cannot access their own cash is not secure. Central banks can print currency. They cannot print trust. They can lower rates. They cannot force banks to lend when banks are terrified. They can announce guarantees. They cannot guarantee the value of the money itself. By 2026, the Federal Reserve faced a trap with teeth. If it printed aggressively, inflation could roar back, eating wages and savings. If it stayed tight, banks would break under high rates. Either path was pain. This is why the collapse felt inevitable. The pilot had no runway. The engines were damaged. The passengers could feel the drop in their stomach before any official statement. In more terms, the Fed was the detective who realizes the city is owned by the criminals. Every move makes the situation worse. Every solution feeds a different fire, and the ledger keeps counting. Meanwhile, the smart money didn't wait for speeches. It moved through the bond market, that quiet engine room of global finance. When big institutions stop buying bank debt, banks lose their bloodstream. This is not romance. It's plumbing. Banks borrow short and lend long. They rely on continuous funding. If funding markets shut, even a good bank can die from a cash mismatch. In early 2026, the flight wasn't only to safety, it was to tangibility. Treasuries, gold, cash-like instruments, anything with low counterparty risk, anything that doesn't depend on a regional lender staying open. That shift is a silent indictment. It says the market no longer trusts bank promises. And without that trust, the business model collapses, because a bank is built from promises stacked on promises. The collapse also accelerates consolidation. When smaller banks fail, their assets get absorbed. Power centralizes. The system becomes easier to monitor, easier to control, and harder to escape. The old American banking myth was personal. A banker who knew your name. A local loan based on character as well as collateral. In a consolidated world, you are a data point. Your life becomes a risk score. Your future becomes a compliance checkbox. Your access to credit becomes an algorithm's mood. The human layer disappears. The ledger remains. This is where the thriller becomes generational. Because banking collapses do not end when the doors reopen under a new logo. The scars remain in lost businesses and delayed dreams. Debt hangs around like a ghost. Failed loans get sold, repackaged, and litigated for years. Municipal budgets tighten. Property values wobble. Younger families delay buying homes because credit standards harden. The aftermath is measured in decades, not days. The economy relearns caution. Regulators rewrite rules. Banks hoard cash. And communities pay the bill through higher costs and fewer opportunities. Some debts, especially those shifted into public backstops, end up being paid slowly through the invisible tax of inflation or reduced purchasing power. The final check is rarely written ceremonially. It's bled out. This is how the ledger rules history, not with gunfire, with amortization schedules, with refinancing deadlines, with the quiet line item called loss provision that eats a bank from the inside. So when you hear banking collapse, don't picture a single explosion. Picture 1,000 small amputations. A credit line cut here, a withdrawal limit there, a forced merger at midnight. And now look at the title again. 1 minute ago. That isn't just drama. It's the warning about speed. In 2026, the distance between rumor and reality is one tap. If a banking holiday ever appears, it will not arrive with a marching band. It will arrive with a notification, a service outage, a maintenance window, a new policy email written in bland language. If you wait for the official announcement, you are already behind the algorithms. That is not fear-mongering. That is the physics of digital finance. This documentary isn't telling you the world is ending. It's telling you an era is ending. The era where you could assume the system would always refinance itself. The era of endless extension. Because the ledger doesn't care about your optimism. It doesn't care about slogans. It only cares whether assets cover liabilities, whether cash comes in before cash goes out, whether solvency is real. Remember the rule of 3. When the cash is gone, the credit is frozen, and the confidence turns, the collapse is not a possibility. It's a schedule. And here is the final lesson, the one history keeps repeating with different costumes. Empires don't fall when the flags are torn down. They fall when the balance sheet can't roll its debt. Banks don't die when people complain online. They die when the numbers stop adding up, when the losses become visible, when the ledger stops whispering and starts shouting. If you want to stay ahead of that shout, you need to understand the story before the headlines write it for you. That's why this channel exists. Subscribe because the people who know the ledger always move first. Stay alert. Stay grounded. Watch the numbers, not the speeches. In the end, history is written by accountants, debt, and resources. And in early 2026, the ledger just wrote another chapter in ink that doesn't wash off.